Hey, well, greetings, folks. This is Gabriel A. Timmons. I have Mr. Justin Gartman here with Better Wealth, and GC Financial have partnered with Better Wealth there with the concept. Where's the book at? The an Asset. So, phenomenal book there. It's a must read. Now, anybody that's listening to this recording and get a free copy of this book, but definitely a great book. Just with the concept and what we're doing, changing lives there. Like I said, Mr. Justin Gartman there. He's a he's a husband. He's a father of four, loves spending family time with his family there. Just has a passion uh to help people. One of the things I love about him, and he has a heart, biggest state of Texas. And guess what? He's in Texas there, but we're just here to help a lot of people here with this concept. And of course, this is the last day of what they call life insurance awareness month. So we're here just to educate you. And hey, feel free, you coming on to the call, take notes. This information is some great information that can definitely change your life there. So without further ado, Mr. Justin Gartman, the floor is yours, sir.
All right. Well, appreciate it, Gabe. Happy to be here. And yeah, what we're gonna do today is walk through. If you've read the and Asset book, if you haven't, I encourage you. You can get a free copy. But we'll walk through what that means, what is the and asset, and how it can, most importantly, how it works, but also how can it benefit you. So I'll say we'll dive into that from the beginning. So, but let's start with why potentially you should be listening to this. What makes sense here from Better Wealth? And so to start, just a quick overview of what this actually is. And so it's going to be a way that we can look at the best ways to store, protect, and use your money throughout your life. So take what you're already doing and make it a little bit more efficient, because that's our goal here at Better Wealth. We want to remove whatever friction there is between you and your desired result. So really figure out where you want to go and how we can better help you get there. So just a quick overview of Better Wealth. We are a financial service company. We are partnered here with Gabriel to help deliver and fulfill on this product. And our goal is to help clients live more intentionally by bettering their finances. We do this because we want to make intentional living kind of the new wealth standard. So it's not about how much money you have, but it's about helping you live intentionally with what you have, and how we can help that out there. So that's a quick overview about us. Feel free to check out. I know through the free book link, you'll also be able to get more information there. Before we jump in, quick disclaimer: this is not specific financial advice for you. This is more for educational purposes. So this is going to educate you on the topic. If we want to see if this makes sense for you, give us a call and we can definitely talk through that. And then another disclaimer, because what we are going to talk about is actually life insurance. So we are talking about life insurance today, but it's life insurance that is most likely in a completely different way than what most people are used to. So want to lead with that. Some people get turned off by life insurance. I encourage you to say, hey, let's look into this a little further, because there's a big difference in the way we'll talk about it and the way you've probably seen and heard before. But then also, this may be a completely new concept to some of you, and it will feel like you are drinking from a fire hose. So there's going to be a lot of information. It's going to be pretty high level today, throwing a lot at you. So it may be a lot to take in. Luckily, this will be recorded, so you can back it up, watch it over again, or just give us a call, me or Gabriel, and we can walk you through more details and answer those questions I'm sure you're going to have. But for others, I'll say maybe you've heard of this before, but you're going to learn more about it. Hopefully, get some more clarity about how it can work, and again, most importantly, how does it benefit you and your family there. So, what we'll cover today, just a quick overview. We'll talk first about all of the multidimensional benefits. So, some of the pros and cons of the product. Then we'll look at the typical design versus what we do, called overfunded life insurance, high cash value life insurance, many different ways for it. But most importantly, you want to make sure it's properly designed. So, we'll talk about what that actually means. We'll look at the 6 core benefits of life insurance. So, um, learn how it grows, learn how it gives you control, gives you the maximum control. Learn how to create more for your future generations. So not just for you, but then also those generations to come. Learn how to be more protected, save more, and also to live more intentionally and powerfully. So we'll start here at the multi-dimensional benefits, and look here that first, this is not an investment. So one, we are looking at life insurance. Never look at life insurance as this is your investment that you're making. Um, but it is a more of a safe place to store your money. But similar to something like an iPhone, it's not really an and versus or. It is both. We're going to be looking at you can have a safe place to store your money and be able to make those investments. But the product, the life insurance policy is not actually the investment. So just like an iPhone, you can have a camera, you can have a calculator, you can have a timer, you can stick all that in your pocket, or you can get an iPhone and you can have all three of those things plus and many more. So that's really how you should view life insurance, as it is a multi-dimensional tool that can help you in many different ways and do a lot of different things. And so first, though, to really give some clarity behind, all right, because you've probably heard some bad things about life insurance. It's a scam. It's this and that, and it's definitely not a scam, but it can be used improperly. But just to show you some of the people that actually have used this in the past. So, not to say just because they're doing it, you should do it. But because they are doing it, maybe we can look at and take a portion of what they do and apply that to your life, because clearly there must be some benefit in it. So one, just looking at presidents, so leader of the country, if they know about it and use it, could be a good thing to look into and consider. Bank owned life insurance. Obviously, you see a billion, that is with a B. So they own a lot of life insurance there, each one of these major banks. So again, is that going to look a lot different than you? Unless you're a billionaire on here, most likely it's going to look a lot different for you. But we can take that same concept and tone it down a little bit. The same thing with corporations. All of these corporations have COLI, so corporate owned life insurance, and they use that in a multitude of different ways. So now, obviously, like I said, their life insurance is possibly going to be used in different ways than what you will, but you can see the value in using it as a place to save that money, get the many benefits. If they're doing that, something you should consider at a different level in your life there. And then also retirement experts. So some of these books here, that's the concept. You can use it in your life, but then specifically down the road, we have the ability to help in your retirement. So we have this book by Ed Slott. If you've heard of him, he's the IRA expert, but he talks a lot about the benefits of life insurance and how it can help once you get to retirement. Make sure that you have enough money to last the rest of your lives. And life insurance can play a big part of that. You also have Dr. Thal, who's an economist. So he's not somebody that is a financial advisor, but he looks at, all right, here's the educational part of it, the academic side of it, and how that safety first retirement using life insurance in retirement years can be a huge benefit. And has all the data to back it up. And then also Tom Wall, who has his doctorate actually in retirement income. He also talks about life insurance there. So those are just experts in the field that help to give some, hey, this, it can be a good product. Again, has to be set up the right way, because just like any product, if used improperly or done improperly, may not be the best thing for you there. So now what we call it the and asset. So very similar to the multi-dimensional, it's the and. We want to make sure that it's not or, it's and you may have heard of this concept before. Maybe you've heard of IBC or infinite banking, be your own bank. Well, we choose to call it the and asset because we like to look at it as, let's take our money, let's put it in here in a specially designed life insurance contract, and let's do the other things that we were already going to be planning on doing or making investments and growing our money, and how it can help us be a little bit more efficient in that area there. So as we look here, we're just going to look at how it compares to what probably the majority of people are already doing with their money. So we're going to look here at 401k or an IRA, have a Roth, have a savings account, and have life insurance, and go through how it compares here. So one, is it safe? And by safe, think of it as, hey, it does not have the ability to lose value. So is a 401k and Roth IRA safe from that perspective? It's a safe vehicle, but it is going to be volatile, meaning you could have money in there and then one day you could look and you can have 30% less the next day. So life insurance product, just like savings, savings not going to go down unless you take it out. Life insurance, same thing. You're actually going to have guaranteed growth with some dividends on top of that, where it's going to be guaranteed to grow, just a matter of how fast it's actually going to grow. And then we have easily accessible. So that's the one of the most important things. You don't want to be putting your money somewhere and not ever have access to it. Now, I'm not saying that a 401k and a Roth IRA are bad. It can be for certain dollars that we want to put in there. We want it to grow there. But for our savings and life insurance, we want access to our money where, like I said, it can be the and where we're going to put it in there. There's an investment opportunity or some opportunity, we can then pull it out, have access, and be able to use it, specifically leverage that. So you can take your, just like that picture there, take yourself, your number one asset, which is you, you put it into a policy so you have opportunities, emergencies, and those opportunities could be investments, could be real estate, could be business, could be any number of different things there. And then competitive growth, because yeah, in a savings account right now, yeah, your money's safe. It's not going to go anywhere, but it's not going to get great growth. Even in a high yield savings account, as of today, it's dropped a little bit below 4% across the board. Yeah, you may be able to find one that gets a little more than that. But historically, in the past, you were getting at maybe 1% in a high yield savings, which is not great. Even 2% is not great. So we know in true investment vehicles in the market have the opportunity to grow higher. That is what they are there for. And then life insurance, yellow, because it's not going to get the most outstanding results, but it is going to get competitive 3 to 4.5% growth IRR. So think of that as if you put money in an account and earned 4.5% every single year with no down years, that's what the IRR is. It's going to grow, continue to compound. Now, if you compare that to other assets with taxes, fees, potentially knowing we have a death benefit, factor in the cost of term, you could actually be looking at, relatively speaking, could be the same as higher growth in another vehicle. But think of it as somewhere around 3, 4.5, potentially even 5.5 if you're young and healthy and actually get there. So good growth. And the big benefit is you want higher growth. Well, that's why it's the and asset. You can have it guaranteed to grow, have access, and go out and invest in something else that's going to give you a higher rate of return because it is leverageable. So, meaning that we can borrow against it to do those things. That's the whole purpose of the and asset here. So, also, I mean, you name it. There's a chance somebody has used a policy, whether it's one of our clients or somebody we know, has done that. So, real estate investing, buying and starting a business, investing in individual stocks, index funds, Bitcoin, or other crypto, any type of thing, even taking vacations with the policy, saying, hey, I'm going to borrow against my policy here, take a vacation, and use that money to do that. Now, everything you look at, there's going to be pros and cons to each thing that you do with it. And so want to make sure, and we'll talk about that a little bit later, but something you can do. None of the other assets are leverageable for the most part. Now, you could get a brokerage account that is leverageable, but in a 401k, Roth, anything like that, you're not going to be able to do that. Guarantees, again, that goes back to the safe. You're going to have built in guarantees here. No percent based fees. Some people don't like that. As your money grows, that percent goes higher. So you're paying more for the cost of managing that. Some people don't like that. Some people it can make sense for, but you're not going to have either one of those in life insurance. Is there fees in life insurance? Is there cost of life insurance? Absolutely. But especially with whole life insurance in a properly structured design, you're going to know exactly what those are from day one. Say you're a 2-year-old and you get a policy, or say you're a 20-year-old and get a policy, you're going to know that is set for your life all the way from day one to age 100. That's going to be the same no matter what. Is it free from regulation? Yes. For the most part, here, you get a life insurance policy. It is a private contract with an insurance company. So it's going to be free from the regulation that can come in and change something where in a Roth, maybe they decide, hey, you start to take out your money later, or there's going to be certain stipulations to do that. Both of those, 401k, IRA, all of that may have some sort of regulation applied to them there. Life insurance, private contract, it's going to be baked into the contract. Once you have it, it's not going to be able to be changed there. Then contribution limits. So a lot of people we work with saving money. Maybe you're going over the amount that you could in a 401k or especially a Roth IRA, and you want to put more money in to a vehicle. Well, you can't in those vehicles. And Roth IRA is about $7,000 right now. So if you have more than $7,000 you want to save or invest, you're not going to be able to put it in there. 401k is going to be a little bit higher, potentially up to about 23,000, or in some cases higher, depending on if you're a business owner and all of that. But at some point, you will be capped out. Or life insurance, you're not going to be capped out on that. You will most likely be able to put as much as what you want into. There will be limits with death benefit and qualifying for that, but for the most part, shouldn't have any limits there. Savings account, obviously, you can put as much money in there as what you wanted to. Creditor protection, life insurance is going to be give you some protection from creditors, which is a very good thing. Meaning, you decide to go out and get sued. Maybe you don't decide to get sued, but no one ever does. And the lawsuit, most likely, depending on your state, you'll have better protection than if it was just in a savings account, similar to a retirement vehicle. But also a brokerage account or something like that would most likely not have that unless it is in a 401k, IRA, or a Roth. Um, we can see here, just looking at the state of Florida here, it gives you an idea of the exempt cash value there is completely unlimited. No matter how much cash value you build up, someone sues you, even bankruptcies, that's not going to be touchable, meaning they're not going to be able to get access to that money because it's in a private contract and it's hidden away there. Same thing for that death benefit there. Again, it does depend on your state, so be aware of that. And then deductible contributions. That's one thing we can't get with life insurance. You're going to take your money. You're going to have already paid taxes on it. You're going to put it in, and you now are going to get the tax-free growth from that point. So not going to get a deduction on it, but it will grow tax-free growth, and then it will be have tax-free use if done properly. So there is a way that you could pay taxes on it, but if you're working with someone who knows what they're doing and knows how to take the money out of it, we can get potentially all the money out, tax free income, leverage it, and then that death benefit comes and will be income tax free to whoever your beneficiaries are. And then finally, get the death benefit. That's what life insurance at its core is. It is a life insurance product, meaning when you die, there will be a death benefit paid out. The way we will structure it is that's going to grow. So you're going to start off with a much smaller death benefit. You're going to end up with a much bigger death benefit when you're most likely down the road going going to pass away. That's when it's going to happen there. So the other ones don't have the death benefit. Obviously, you would take that money that you did have, and that could be passed on. Depending on if it's in a 401k Roth, there's going to be some different stipulations to how that works. But life insurance of itself, that's the easiest way to pass on money because that's ultimately what it is designed for there. So those are some of the benefits. Again, looking at the multidimensional ones, how it compares there. And then also, we're going to have another benefit, which is a chronic illness and accelerated benefit. So think of these as your living benefits. One, the most important living benefit that you have that most people want is just the access to the cash. You can leverage it, use it, rinse and repeat. But also going to have some of these benefits where if you have a terminal illness in most cases, so go to the doctor, they say, hey, you have 12 months to live. Well, you can accelerate that death benefit, mean get a portion of that death benefit to use right now, to use in that last year there. Maybe you use that for medical care, use it for something else, but you're going to get access to do that if you need it. If you have other assets that could help cover something, you could use that, but you can get access to that death benefit, accelerate it, get it before you die there, which is can be a very beneficial thing if needed, as well as chronic illness. Think of that as if you generally it's 2 of 6 daily living activities. You need some type of care. You need to stay in a home. Or you need to have some care come to your house. If you have those, you can again accelerate your death benefit, and that every year it'll be capped out at a certain amount. But you'll be able to get some money from that death benefit before you die to help you kind of live the most intentional life you can in those last years of your life, or however much that care is. There's been instances where hey, you need care, you use that, and you get better, and now you're able to continue living your life, still have your death benefit intact, life insurance policy intact. You had just used a portion of it there. So can be a very big benefit. One, you hope you don't need it, but it's going to be there if you do. So all that to say, I kind of spend a lot of time on the multidimensional aspects of it, but you can see it can be a great place to store your money. It can be leveraged to invest. It is tax advantaged. The chronic illness accelerated benefits, and also just looking at the experts agree. Having a life insurance as part of your financial plan can greatly improve it. We see some of the people in power, people who are presidents and businesses and banks using the same concept there. So it's something you also have access to and can do the same thing that they are doing. So that was the multidimensional benefits. Now let's look at kind of more on the technical side of, all right, you're talking about this stuff. It's life insurance, but I've heard bad things about life insurance. Well, let's look at the differences because I would say I would definitely agree that some people out there say, hey, life insurance is that scam. It's the worst place to put your money there. And again, life insurance isn't the scam. Maybe how someone told you you could use it is, and they gave you something that was not as great of a product. And I'd agree. When it's done improper, it's really a bad vehicle. It'd be like you go into the car dealership saying, hey, I need something that's going to give me great gas mileage, something small that I'm going to drive around a lot. And they sell you a big old F-250. Well, that's not a bad vehicle, but it's not for the job that you would want. So that's really how we can look at life insurance. It's a tool, it's a vehicle. Yes, it is a vehicle compared to a vehicle there. And it's going to be something that when set up properly for what you want it for, we want to make sure that's done and it can be a big benefit there. So, one, as we look at it, what is very important and just how it works is you're going to have yourself, you get to be the stick figure. You're going to have an insurance policy. That's the private contract. And then you're going to have an insurance company to work with. Both of these pieces, the company and the contract, are very important. And I'll say, as well as yourself, is very important. We need to be healthy. That's going to give you the best shot at everything's going to look better the healthier you are. Now, if you have health problems, different things, there's ways that we can also work with it. And we are the experts. We have a great internal underwriting team that can help us figure out, all right, health's not the greatest. Let's see what we can still do. But mostly focusing now on the company and the contract there. So first, the company. You want it to be a mutual company versus a stock company. Mutual meaning you are part owner of the company. They're going to pay dividends because it's a participating company, and not worried about just pleasing the shareholders. Those dividends are going back to every single policy owner that you have there. So every single participating. So in a whole life policy, that is what is getting the benefit there. So it's more of a benefit for you versus just the shareholders that you're trying to please there. Also rating. So we want it to be a very strong, financially sound company. I'm talking A ratings across the board, so that you know they are in a good spot. And one, if you're looking at a whole life insurance policy or permanent policy, you want that to be around your whole life. So you want that company to be around your whole life and be in a good spot. Is also have that long term track record there. So most of the companies we work with, a few of them been around 112 years, 150 plus years, 170 plus years. So they've all been around a very long time. They've been through many of the depressions, Great Depressions, world wars, all of that stuff, and continue to be financially sound, continue to have never missed a dividend. So that's going to be one, the most important part. You want to make sure you are with a good company that's going to be around for a long time. And then the contract. Think of this as the design that you're getting. So you want the contract to be a very solid contract, solidly designed, in which the contract really, in and of itself, is going to really lock you in to that. But it's going to be flexible. It's going to make sure that we're going to get the most benefit for what you're looking at, which is what we help do. Have a conversation, figure out your goals. One policy for somebody may make no sense for somebody else. The same thing there. Policy for them wouldn't make sense for this person because they have different goals. They're in different stages of life and they're looking for different outcomes. Really wanting to help them live more intentionally. And that's going to be something that we help with. So get to know you, get to figure out what you're looking for. And then from there, use our expertise to figure out the best design and contract for you. Uh, One thing, term versus permanent insurance. I'm sure everyone here knows what term insurance is. It's cheap, one, which is great. It can be a way that you're going to get a large death benefit for a small amount, but at some point that term is going to run out. So maybe 10 years, maybe 15, 20, 30 years. But whenever that term ends, you no longer have the death benefit in place. We still use a lot of term insurance because, like I said, we're minimizing the death benefit to give you cash value, but that's going to grow. So term definitely has a place and is a good thing, but no one wants to actually have to use that term insurance. It's there as a protection in case something happens to you. The permanent insurance, something's going to happen to us all. Eventually, we will all die. So that permanent policy is going to be in place on that day, whether it's 10 years from now or whether it is actually 100 years from now, 120 years from now, whenever it is, that policy is going to be in place there. So that's what we want. We want to make sure that it is there. And both of them can be useful. Again, just a matter of it's a tool. is it right for your situation and your goals and what you're looking for there, as well as the permanent builds up that cash value. So this is where the special type of life insurance, and I would say don't even think of it as special type of life insurance. It's life insurance, but it's properly designed here. So we will maximize the living benefits because most people aren't looking, especially if you're younger, to just put money away that someday the next generation is going to get it. Yes, we want to benefit the next generation, but we also want to have living benefits. We want access to that money during our lives so that we can use it. So we maximize the living benefits, we minimize the death benefits, at least early on. That's going to continue to grow. So when you most need that death benefit, when you're most closer to that time of death, it's going to have been growing and be much higher at that point, which is where we really want that to be. So the pros of a properly designed policy, and it's going to be safe. So, like we talked about, creditor protection, guaranteed to grow, liquid, you have access to it, lifetime growth, leverageable, you can borrow against it, use it. Creditor protection is private, so it's not something that has to be disclosed there. It's a private contract. The tax free growth, tax deferred growth, tax free use if done right, and a death benefit at the end of the day. The cons of something like this, because if anyone's telling you that everything is perfect and there's no cons, well, it's probably not true. So there is cons to this. One, it's not tax deductible, so you're not going to get a tax benefit for putting money into the policy. It's going to be after tax dollars. 4 to 7 year break even. So think of that. If you've heard of this before, I'm sure you know what that is. But if you haven't and this is new, think of that as there is not going to be dollar for dollar access from the moment you start a policy. So it's going to take 4 to 7 years before you actually have more cash value available than what you have actually put into the policy. So it takes a little time to capitalize to build that up. Now, during that time, you're getting the benefit of a death benefit and all of those good things and all the other benefits. But if you're looking at it truly just from a cash accumulation standpoint, if you had $100,000, $10,000, whatever it was you're putting in, and you put that into a policy, you're not going to have access to all of it. Maybe you have around 80,000 or $8,000, depending on what kind of camp you're in right there. The other thing is not everyone qualifies because of health. So everyone can put money into a savings vehicle. Most everyone can do something in a Roth or 401k. Obviously, you have to be working in some small caveats there. Everyone can put money into a brokerage account, but not everyone can do this concept due to health reasons and stuff like that. Now, like I said earlier, I know there's some ways that we can go about making sure you can do that or give you the best shot at it, and so something to talk about there. But that can be a con there. So here's some actual numbers here. You're going to see typical design here. You put in $50,000 each year. So if you look at the beginning up there, you put in $50,000, you have $0 of cash value. Next year, you put another 50 in. Now have another $0 of cash value. It takes time to build it up. And that's the traditional, typical whole life design. You're going to start off though with about a $4 million death benefit that does slowly grow where eventually you do start to get cash value, but it takes a long time. And like I said, most people, this isn't going to be the right product for them. Where this is at the same company, but just a max funded design, optimally funded, overfunded, however you want to call it. It's going to be properly designed for you and getting that initial early cash value. So same thing here. Now you see $50,000 goes in, same money goes in, but you have nearly $40,000 of available cash value in year one. And then as you put money in, that break even point is going to be a lot quicker than in this policy over here. The biggest difference you'll see here is you start off with $1.3 million. So most of it's going towards we're building up the cash value, cash accumulation versus not just paying for an immediate death benefit. So if you want the death benefit, though, we want that closer to hopefully when that time of death is. And if you look down at the bottom here, they end up being about the same. So you end up having you have $5.8 million of death benefit in one, you got $20,000 less in your other death benefit there, but you had a much higher amount of cash value and use of that policy all the way up to that point. And eventually that death benefit would surpass even the other one. So your typical policy, like I said, is a high base. So think of that as that's the minimum cost of insurance that has to go there. It's not giving you any early cash value. It does build cash value over time, but it has little to no cash value early on. And it's not flexible. So say you're putting in $50,000, that's the maximum you can put in. You have flexibility down in a high cash value policy and a base policy. That base, that's what you're committed to. You need to pay that every year for at least a long time. So not flexible. And say you have a bad year, can't put that in there, especially as we're looking at it as more of a savings vehicle. There may be years where you don't put as much in. There may be years where you put more in. Not flexible in your typical policy. Takes 10 plus years to break even. Um, that's generous. Most of the time, it could be 12, 15 plus years before that actually happens. And that's where you have more cash value than what you have put in premium. So this is that same policy. You look down here, year 12 break even. So finally, you've put in $600,000 and you have $608,000. And if these numbers here, I'll say you're like, hey, I can't put $50,000 in. Just think double it. If you can put $100,000 in, numbers are going to look almost the exact same, or half it, and that's going to be what it looks like for you. It's going to be fairly linear as far as it works. So you can just divide that to whatever makes sense for your circumstances. Now, that's the typical design. Let's look at the specially designed, properly designed to make sure that hey, we're maximizing that cash accumulation. Um, it's going to have really three components. One, it is going to have your base amount of insurance, but then you're going to have a paid up additions rider. This right here is going to be the good stuff. This is what is giving you immediate cash value. So we want to maximize the paid up additions rider. That's where the majority of that premium is going to be going. Then you're going to look at a term rider. So that term rider is a way that we can get more death benefit for a cheaper cost, which enables us to then maximize those paid up additions. And so it gives you a lot of early cash value, just like we saw there. You have a lot of flexibility because that PUA rider, the paid up additions, that's optional amount there. You can pay all of it. You can pay half of it. You can pay none of it in some years. And that can give you a great degree of flexibility. Um, and so it also, you're paying 1/10 of the commission there. So most of the time, think of the base amount of insurance. That's where majority of your commission comes from. For someone like myself, someone making money off of this. And so the benefit is you're getting that high death benefit. You're not getting early cash value. So we flip this, do it this way, and you're getting immediate cash value, much more benefit there. What could be part of the reason why maybe a lot of people don't do it this way is partly because it's just not um, out there a lot. It's not the traditional way of doing it, but also it may not be as much of a benefit to whoever you're getting the policy from. So here's that specially designed, properly designed. You see now it's year 3 or year 6 here. Put in $300,000 of total premium, and we have 309,000 there. You see, it was almost the prior year in year 5. And like I said, sometimes it'll be year 4, 5, 6, 7. Typically, it's going to be somewhere there, and then just gets better and better as you go. So that's how it would work. Now let's look at some of the actual benefits here. So these 6 core benefits here. We're going to look at first you yourself. You are the number one asset there. You can look at that, and I think everyone should view themselves that way. And then we have our money here that we get from life insurance, which is protection, legacy. So death benefit in place, families protected, pass that down to different generations, going to get lifetime growth. Once a dollar goes in, it's going to grow for the rest of your life. You get control and use. You get future cash flow. So think about retirement planning. If we need to use that in the future for some income, we can use that. But also the ability to save more. It's a place that you can put your money that you know is going to do all these things. You're much more likely to want to put that money there. So one, that lifetime growth. So the internal rate of return, which we touched on briefly, is just a metric that used in financial analysis. Think of it as if we had all things equal, put money into something, it is going to be if you earned, call it 5% every single year with no down years, you put that money in. That's what IRR is. So that's what is being calculated there. Now, inside of a policy, a contract, there's not going to be taxes, fees, cost of term, all of that stuff. So you would have to compare it to something like that to be able to get the benefit there. So that's where that tax-free lifetime compounding comes from. This is kind of the tax code here. And so you can see that you're going to save a lot on taxes because it's growing. And then when you pass it on, you're not going to pay income tax on that death benefit there. So that's where you're not interrupting the compounding by, hey, every year we had to pay taxes on it, or we had to pay a fee from inside of the policy. It's going to grow that way, getting that IRR, that's that same steady growth every year that grows over time. And so Albert Einstein, whether he actually said this or not, it's kind of attributed to him. The compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. So that's a way where we want to earn that interest, not pay that interest here. So you see here, obviously, it's that it doesn't grow much, but compounding due to the end, you see the skyrocket at the end there as it just gets better and better and better with time. So it's the amount, your percentage, and time, all of that combined together here. And to look at the actual IRR calculation here, you see same policy we looked at earlier, $50,000. Again, you could take this, have it be 100, have it be 25, whatever works for you. Numbers and percentage IRR would be the same. So you see early on, it's negative because we put in 50, and it's just on the cash value. You have less than what you initially put in. You have access to less. You still get the death benefit and you're getting all the benefits, but you have cash value less than that. And so over time, we finally get to that break even point at year 6, which is pretty quick. Then that's where the IRR starts to climb up. And so this would be, if we put in a savings vehicle down here, we would earn 4.58% every single year. So it'd be like if you put it in a savings account and that high interest savings, and you were getting that 4.58% every single year for all of those years without paying any taxes on the interest, and it was just compounding every year. That's what the IRR is calculating right there. But you look at that and say, 4.5, maybe it's not that great. You look say, hey, stock market can get 7. My high yield savings gets close to that right now. But it's really, as we compare that to what, it's because it's looking at it differently. The tax free, the lifetime growth without any interruptions really makes a big difference. And so um, we can look at this calculator here and say, hey, if you had a 4.5% internal rate of return, just like we had there. It was a little higher. And your tax rate was at 30%. Obviously, if it was at 20%, it would be less than that, and no management fees. So think, hey, just on a savings, but that 1099 you get in the high yield savings, you do pay taxes on that. It would take at least a 6.43% growth rate to reach that same amount over time. So that's where you can look at the numbers and the percentage, but sometimes those percentages can be a little bit misleading because that's a higher percentage, but you could end up at the same number there with taxes, fees, all that stuff. Same thing here. You add that management fee. Now we're looking at 7.49% needed to be able to at least match that growth there. And then even more so, you add in cost of term. So think, I want to do these things, but I also want a death benefit. Well, term costs money. Now you're looking at nearly 11% that you would have to earn in another asset to get the same benefit there. So again, not saying life insurance is the investment and this is what you put all your money into, but showing you the difference where even though it was yellow up there on that rate of return, if you compared it to other assets, it may actually be a little bit higher there. So that's where the compounding happens. Also, if we look at other assets, what eventually you're going to start taking that money out. So most of the time, age 65, just typical retirement age. But your life insurance policy, we're going to continue to grow because even though you're leveraging it, you're borrowing against it there. So even though you're actually using it, it's actually continuing to grow there. And so you see that big difference there. And so a lot of times, hey, it makes sense. Have both. You're going to have your growth. You're going to have your investments, get to retirement, use those, but then also can use your life insurance. It's going to continue to grow along with that. Then we'll touch on the control and use life insurance set up properly. We're leveraging it. So it's a collateralized loan. It's continuing to grow, which is why it's the and asset there. You're competing, compounding, control, always competing. If you use the money, you're going to lose the compounding. But if you want the control and in your hands, then you're not going to get the compounding. So it's kind of a tug of war there. It's a matter of credit versus debit. Do we want the credit? So we're not using our money, or do we just pull the money and we're using that money and it's gone forever? So that's what you are allowed to do with life insurance. You aren't using your money. You are using the life insurance company's money. You're borrowing against it. Yes, there's a cost to do that, but this allows you to pay it back while your money continues to grow the whole time and then rinse and repeat as you refill it over time. So biggest question we always get, when does it make sense to borrow? Um, Typically that answer is just going to be And the most basic level is when that activity you're using it to borrow against is greater than your cost of borrowing or your cost of control. So that's your control cost. And a lot of times right now, that control cost is going to be around 5 to 5.5% at most of the companies we work with. So you can also use it for many other things, emergencies, different things like that. But the highest use, the best use, and most beneficial would be when you can borrow it, make an investment, and that is actually going to earn more than what you are paying for it. And you pay it back, and you're getting growth in two places rather than just one. So that's what the banks do every day. They take a deposit, which is a liability, then they loan out at 4%. So in your case, hey, you're kind of borrowing at 5%. Maybe you're earning 10%, and that rate of return is actually 300% because it's not just a 3% what you're doing. Your cost was 1%, but you're earning 4. So that rate of return is actually going to be higher. And that's what banks do. And that's why banks make a lot more money in lower interest rate environments because they can give you a lower interest rate. 4% loan is still pretty good, rather than like it is right now, where, hey, maybe they're giving you 3, but the interest rate is 3. That's just a double rather than a 300% there. You can look at, if your control cost now looking at life insurance is 5, but your investment can only earn 2%, that may not be the best move for you. You're going to have to look at the math and say mathematically, it doesn't make sense to do that. If you can borrow at 5 and earn 5, hey, you broke even. If you can borrow at 5 and you earn 7, well, now it's a 40% rate of return. 5 and 12, it's 140, and so on from there. So just to show you the highest and best use case there. And so a lot of this people we work with look at, we have money. One, we want to make sure we have an emergency fund. I like to say you should also have an inconvenient fund. You need some money in the bank, get a flat tire, wash your dryer brakes. Don't want to go to your policy to do that. Get your money from there. But for a true emergency fund, meaning, hey, I lost my job, I'm going to need to use this just to get by with. A lot of times that's not going to happen. We're not going to need that. And it can be stored in a life insurance policy and used as needed there. And then build up on that best use case, that opportunity fund, which would be business, real estate, the market, anything like we talked about. It could be numerous activities, and you earn that money there. And then guess what? Now you're making more money and it's refilling the bucket. And it's a process the entire time that is growing as you add more money to this. Your opportunity fund is growing. Maybe your emergency fund's growing. You're staying the same, and you just rinse and repeat over and over and over there. Um, and then future cash flow planning. So that's while you're alive, you're constantly using it there. And then it can help out in that retirement there. So with future cash flow planning, and we won't spend a lot of time on this, but it is going to give you that death benefit. So you know, hey, I have my assets right here. I can spin down most of those assets knowing that if I want to leave something to my family, it is still going to be there to be passed on. It can be a volatility buffer. So think whatever assets you have, call it assets in the market. Things are going up. That's great. As they crash down, we don't ever want to take income from that because now it doesn't get an opportunity to grow back again. And we sold at a loss. You have to pay taxes on that depending on what vehicle it's in. And it never gets a chance to recover and can really hurt the longevity of that retirement income there. But if you had another bucket uncorrelated to the market crashes, you borrow from your policy or use your policy, then market has a chance to recover, and you end up in a much better spot there. Covered asset strategy. This one would be something where maybe you have a pension and you have the option to choose, hey, I can either take the larger income or I can take a joint benefit. Well, if you have a life insurance policy, you can take the larger income, get more income. And if you live for a long time, great. You ended up with a lot more money. If you don't, and you were worried about your spouse, well, now that death benefit covers it and you get that lump sum coming there. Or same thing can be done with an annuity. Buy an annuity that doesn't have any return of that premium, which is a big concern because now you could lose that money. But if you also have the policy, you're just taking the chance on higher income for the rest of your life if you outlive that and have the policy in place where if something does happen, well, guess what? It refills there and you're not worried about that. Also be reverse mortgage. Take income from your house, use a reverse mortgage. That death benefit comes in and can pay off anything there. Also, that tax shelter, because we are going to be paying an income tax-free death benefit out to the beneficiaries. Can be used in a lot of different ways there, and can get really deep on the actual estate planning as you go there. Which, speaking of, that's the first and foremost core reason for life insurance, is that protection and legacy. So it can provide protection if something happens to you now, but also help you leave a legacy with that estate planning, which is going to be income tax free. And I say income tax free because if you're over that estate threshold, you may still be paying some of those estate taxes, depending on where your life insurance is at, how it's held. But income tax free for sure. So you're not going to have to pay that, which can be a big benefit in helping that, especially you have other assets that you can go ahead and spend down to make sure something is left to your family. Um, and then that other reason was just the ability to save more. So right now, you put your money in your savings, you're not earning much. If you use it, it's going to be gone. But if you had the ability to get all of these benefits, and what we've seen with a lot of our clients is, hey, that gives us the ability we can actually save more because we like where we're putting our money. Um, and we know that it can kind of be a forced savings. That premium bill comes due. While there's lots of flexibility in it, hey, right, I better pay this, and then you're building up your savings there. So it gives you the opportunity to save more, knowing you can still use it, still get the growth. And then also now it can help you out there, knowing you have all of these things, knowing that you can borrow against this and have a unstructured repayment, give you some flexibility there. How might you actually show up knowing that, hey, we have this, let's help us live more intentionally with this asset there. Because that's ultimately the number one goal of us here at Better Wealth is the reason you should get this is for these benefits because it will help you show up more powerfully and live more intentionally in your own life there. So at the end of the day, give your dollar more than one job. It's the and asset. It's not or, it's and we want to be able to do all of the above right here. So and is always greater than or. And it's going to be something very important there. And this is one of the few vehicles that you can do that has the built-in guarantees and all of those benefits. So now you may be thinking, wow, this sounds great. How do I figure out going about doing this? Well, first it's going to be contribution. We got to figure out how much money you had actually want to put into something like this, whether it's you are sitting on cash, hey, let's get that into a policy, or you're like, hey, I'm saving this amount of money already that I'm going to invest. Let's look at what that would look like. Solving for that number first would be something to figure out. Figure out now we're going to maximize that cash value. What are your goals? How are you going to use it? Let's get you the best design. And then you're going to minimize the death benefit. But that's where it all starts. And so I'll say back to the contribution. If we're not saving any money right now, you're not having anything put away, you're not already sitting on some money, it starts there. We got to be able to save some money first, be in a good spot financially. This isn't the tool that's going to fix all your problems. It's a tool to add to that if you're already a disciplined saver and already in a pretty good spot there. Uh, and then we can get all of these other benefits there. So at the end of the day, simple picture, lifetime growth. You take your dollar, you put it in a policy, you're going to get lifetime growth. So for the rest of your life, no matter how long you live, and you're going to get control and use. So not only lifetime growth, but you're going to have access to that dollar. You're going to be able to use that dollar for anything that you want. Then there's going to be future cash flow. So control and use all throughout your life, retirement planning, future cash flow. You're going to be able to do that, and you're going to have that protection and legacy along the way. So all of those things are going to be factored in for you there. So with all of that said, I know there's going to be a link. It'll take you to our vault. You'll also be able to get a free book there. So fill that out, schedule a call with us, reach out to me, reach out to Gabriel. We'd be happy to help walk you through. If you see the benefits in all of this, how is this actually going to help you? Does it make sense for your situation? I'm happy to help you. Most importantly, show up, live more intentionally in your own life.
Man, awesome job, man. Justin, man, thank you very much. You couldn't get no better than that, folks. But thank you, man, for what you done, man, explaining this process there. I know for myself and Justin are both we viewed this concept. It's changed our life personally. With this concept there, I have a saying, I eat from my own stove there. I used it to fund my business time, use it there for some things there for helping one of my daughters before. So you can use this concept several different ways there, but the most important thing here is that we're here to educate you. This is not just a one phone call and like a traditional life
Yeah.
insurance policy. And the thing I'm excited about, this is the last day of what they call Life Insurance Awareness Month. So we're just here to educate you there and get the information there. So hey, if this is recording, hey, please take notes. Like I said earlier, there, get back with the person uh who sent you this video. And then also please like and subscribe to GC Financial YouTube channel. And thank you again, Justin, here with Better Wealth. And our slogan here at GC Financial is we build your future one step at a time. And thank you again for joining us here on our webinar today. Thank you.